problems with everybody. And on the left hand of our screen, I have just our book open, our ebook open, with a few of the problems I'm going to go over with you. On the right hand side, I have the Chapter 12 textbook Excel open. On your own, it would be good just to kind of go through the various tabs here. There's a what they call the Chapter 12 model. They talk about an expansion project and then what that would look like. I'll expand that here just a bit. And what that would look like in terms of calculating the cash flows for a particular project. And on the left hand side, they kind of walk you through how to compute the cash flows. So think of it as an income statement that you're turning into a cash basis by going through doing what the cash flows are with the revenues less all the costs that go into producing something, getting your EBIT, your earnings before interest and tax affecting it, then adding back depreciation. And we add back depreciation because depreciation is a non-cash item. So we have to include depreciation up here to properly get operating costs and to properly tax affect that. But then once we got the tax effect taken care of, we just simply add back depreciation to get the pure cash that will be generated by the project. So just wanted you to kind of just see that format there. We'll come back and use an example or two with that same format. So from there, let me just make this go back on the other side of the screen there. And this first problem here, problem 1 for Chapter 12, does not require really any computations, but I just want to cover a couple things with you about this with you. The question is, Canon Industries is considering an expansion. The equipment would be purchased for the expansion, $18 million, and would require a $2 million investment in net operating working capital. So the total cost of the project then, question A, is $20 million, just simply the 18 plus the 2, $20 million. B is the company spent and expensed $20,000 on research related to the project last year. Would this change your answer? Explain. And the answer would be no. And the reason is because this is a sunk cost that happened in the past and does not represent what we'll call incremental cash flow. And remember that incremental cash flow is cash flow that's changed from the base case. So we only focus on incremental cash flows, which are cash flows that have changed somehow from the base case to the new scenario. So that's happened in the past. Nothing we do about this $18 and $2 million investments will change that. So it's a sunk cost that we would not charge to this particular project. Letter C, so the company plans to use the building that it owns to house the project. The building could be sold for $1 million after tax and real estate commissions. How would that affect your answer? So essentially, they're facing a choice. We can either spend $20 million to buy equipment and the working capital needed to start the equipment and make something and put it into an empty building. Or we could just simply sell the empty building and make $1 million. And so we've got two choices. So because that is a potential sale, it's something that represents an alternative, that's more future based, we do need to charge that to the project. So when we figure out the cash flows for this project, we'd go with the initial investment of $20 million plus we'd add this $1 million net of tax. And actually this $1 million is after tax in real estate. So we'd add that $1 million and say really the initial cost is $21 million because we're giving up $1 million revenue that we will never get again. So we have to add that to the project cost just to make sure that all the future cash flows are high enough to make sure that we do the right things. So in finance we include things like that. In accounting you wouldn't do that, but in finance we have to think about the possible effects of the alternatives that we could do. So that just comes into play. Okay, the next question is more of a number cruncher, and that's question 2. It says that here Colson Communications is trying to estimate the first year cash flow for a proposed project. The financial staff has collected the following information on the project: $15 million of revenue, $10.5 million of operating cost, depreciation is $3 million, and interest expense is also $3 million. And so it says here, what is the company's tax rate is 40% and the WACC is 11%. So what I'm going to do is just go over to my Excel and just, I think off to the right somewhere here, I'm just going to do this answer for us here just in Excel, and I think that'll hopefully help you figure it out. So you can obviously do this in pencil and paper. The nice thing about doing in Excel is once you kind of build this model, you can use it for other problems too that you'll get. So I'm just going to abbreviate and just kind of start this out here. Sales revenue would be my first line. Operating costs would be another line that I would use. And then I'm going to put in depreciation. So basically I'm building just a mini income statement based on the information they gave us. So 15 million, my revenue number. And then operating cost was the 10.5 million. And then depreciation was 3 million. And you might be thinking, why not use the interest expense number? And I'll tell you what that reason here in just a second. So I'm going to add these numbers down. So I'm going to do plus revenues minus operating cost minus depreciation, and I get 1,500,000, and that's essentially my EBIT, earnings before interest and tax. Now, it's a little confusing because we haven't used interest yet. The reason we haven't used interest yet is in the chapter it mentions and talks about the fact that when it comes to computing cash flows, we never take into account interest. And the reason for that is the WACC, the 11% WACC for in this problem that we're using, takes that into account already. So if I included the $3 million expense over in my calculation for cash flows over here, I'd be double counting the effect of interest. And so basically the WACC is saying my cost of obtaining capital, wherever that capital comes from, if it's loans, my own retained earnings, issuing common stock or preferred stock, the average of all that's 11%. So as long as I use 11% to compute a net present value, that will take into account the interest expense, the interest component. So I'm okay. So I don't need to include that $3 million. So once I have my EBIT, I need to tax affect that. And they said the tax rate's 40%. So I'm just going to take 40% and then multiply that by the 1,000,005. So that's my tax is 600,000. And so then after tax, we'll just do 1,000,005 minus 600. Hit enter, and we get the net effect, which is my EBIT, basically at the 1 minus t, okay, after tax. So 900,000 is what I've got, and then from there I add back my depreciation because I need to include depreciation above to get the proper EBIT and the proper tax, but then I add back depreciation. So I'm just saying AB, oops, if I can type correctly here. This AB for add back, that's the only reason I'm just abbreviating here. And I'm just going to just simply add those last two numbers. And of course everybody can do the mental math and go, that's 3,900,000, but we'll just do that for the calculation. So essentially I get 3,900,000 then as my project cash flow. So there is my cash flow, CF for cash flow. So project A, or I'm sorry, answer A is 3,900,000. Answer question B says if the project would cannibalize other projects by 1.5 million of cash flow before tax, how would this change your answer to A? So hopefully you're realizing, oh, if we launch this project and we make a product and people will buy less of other products that we're selling because they like this one better, that's an externality, what they call a negative externality. And so because of that, I will now have to go through and charge my project for that amount. Okay, so basically what I would do is just go, oh, it's 1.5 million before tax, so I would just say, okay, 1.5, multiply that by my tax rate. We'll just, oops, we'll just do it like this. Go plus 0.4 and then times the 1,000,005. So my tax would be 600,000. So the after-tax effect of this would be 900,000. So let me just do the math. And so essentially what I would do is I would say that's a cost of this project. So if that were the case, what I would do is I would reduce the cash flow above from 3.9 million down to 3 million. I would subtract the net effect of this revenue loss away from the cash flow and just say my project cash flow will be 3 million instead of 3.9 million. For letter C, it says ignore part B. If the tax rate dropped to 30%, how would that change your answer to A? So what I can do is just go to my tax calculation above and go, I typed in 0.4. So notice it's 3.9 million. I typed in 0.4. Let's change that to be 0.3. And you get a new number, 4,050,000. It goes up. So the fewer taxes we pay means we have increased cash flow. We now have more cash flow that we can use for the project. And of course that would increase the project's net present value because the cash flow went up. So just know if the tax rate goes down, cash flow would go up and vice versa. Okay, that was question 2. Question 3 is replacement analysis. And with replacement analysis, it's basically going to be a little bit of a reminder of your accounting class and the accounting portion where you talk about disposal of fixed assets, of property, plant, and equipment. So with this one, Oviedo Company is considering the purchase of a new machine to replace an obsolete one. The machine being used for the operation has a book value to market value of 0. However, the machine is in good working order and will last at least another 10 years. The proposed replacement machine will perform the operation so much more efficiently that Oviedo's engineers estimate that it will produce after-tax cash flow, which is labor savings and depreciation, of $8,000 per year. The new machine will cost $45,000 delivered and installed, has a life of 10 years, has 0 salvage value, and the firm's WACC is 10%. And its marginal tax rate is 35%. Should Oviedo buy the new machine? So we have to figure all that stuff out, right? There's lots of stuff we have to process there. So let me just kind of scroll down here and get us a blank spot in the file. Let's kind of work through what we got to do here. Okay, so for this one, we need to think about what is the book value of the asset. Oops, you know what? I skipped one by accident. Hold on, we'll do this one, but I think I skipped 3 and I didn't mean to do that. We'll come back and do 3. I meant to do 3 and 4. So we're doing problem 4 here. We'll go back and do 3. So for this one, what we have to kind of think through here is we're going to spend $45,000 today. So I'm going to put in a 0 for today, times 0. And then we're going to put in a whole bunch of numbers here. So I'm going to just do a timeline, just so you can kind of visually see it. So we got 10 periods. So I'm just going to type in all those numbers here. Okay, and then today we're spending $45,000. And we spend $45,000, and what we get back is cash flows of $8,000 per year for 10 years. So let me just do a copy and paste here if my computer will cooperate. There, I get my spinny wheel. There we go. I'm using my Mac to do these, and it's a little bit older and a little bit slower. There we go. So let me get this pasted here. Okay, so basically my timeline is 45,000 today and 10 periods of 8,000. So one point about the cash flows here is it said the cash flows are increased labor savings, more efficient use of labor, so we can use less labor, and depreciation. So just know that a positive cash flow can just simply be reduced expenses. It doesn't have to be actual cash we receive in the door. It can literally just be, I'm more efficient in my operations, so therefore I'm saving money, so there is my positive $8,000 cash flow. But I'm spending $45,000, I get positive $8,000, and that's basically my setup. So the WACC is 10%. I'm just going to type in a 10. Actually, I should have 0.10, but Let me just make that be a percent here. And let me just maximize this so everybody can see the whole thing. And I need to format that to a percent. There we go. Right there. So I got to type in a 10 again. So here's my setup. So the timeline is I've got $45,000 I spend today. I have $8,000 a year for 10 years. I've got a 10% cost of capital. And essentially the question is, should we invest $45,000 and save us $8,000 per year? Should we do this, yes or no? And net present value would be the way to figure this out. So there's a couple of ways to tackle net present value. The Chapter 11 Excel, I showed everybody in a recording previously when we did Chapter 11. You can open up the Chapter 11 textbook Excel and look at the recording I did for that. And I showed you how to just adapt the formula that was provided and just turn it into any numbers you want. Or we can just build one from scratch. And so to build one from scratch, and I'm using Excel for a Mac, but Excel for Windows, which I'm guessing the vast majority of you are using, there is a tab that says formulas. And just when your ribbon bar across here, there would be one that says formulas. It's going to look a little bit different than mine. Excel for a Mac looks a little bit different, but just click on formulas. And then once you find formulas, what you can do is you can just go ahead and there's lots of ways to do it. You can type in equals NPV and build one. You can do formula builder. There's lots of ways to find it. But anyway, just if you go to the formula and then my formula builder, it just almost always when you find your formula builder, NPV would be one that just shows up, and that's the one you want. Okay, so I'm going to just double click on NPV, and what it's going to do is it's going to give me some options to fill in some blanks here. So I'm going to choose a rate, okay, and my rate is 10%, and then I'm going to choose the values, and what I want for my values is the sum of years 1 through 10. Okay, and so I've got that in there. I'm going to hit enter because I'm done. And I'm not quite done yet. I'm going to close my formula builder now. I'm not quite done yet because this is the present value of years 1 through 10, but I have to add back the negative 45,000 from today, times 0. To do that, and hit enter, and it's thinking about it. I get the spinny wheel. But once that answer shows up, that is the answer to the problem. And if you can recall, for net present value, as long as that number is positive, usually the answer is yes, we'll do this. Because if it's positive, that means, and it's defaulted to a whole bunch of decimals there. Didn't need to do that, but well, let's move that down. There we go. Let's get that to a reasonable number. So it's 415654. That means by doing this, I'm adding value to the company of $4,000, $4,156.54. So I am adding value to the firm by doing this project. So I would do it. Okay. But anyway, I just want to show you how to build an NPV formula from scratch. In Mac, it looks a little bit different than it would for Windows, but it's essentially the same process. Or just go back to the Chapter 11 textbook Excel, and you can take an NPV formula that already exists there. It's put in your new numbers, and you'll be okay too. So that's how we did question 4. Question 3, which I did not mean to skip, but I did, is this is the one that you're dealing with salvage value and some of the stuff you did in accounting regarding disposal of property, plant, and equipment. Now we're not doing journal entries and debits and credits, but the same concept applies where we have to figure out what is the salvage value, book value, how much money do I receive versus book value I'm giving up, some things like that. So it says here that State Air Services, final year of a project, equipment that cost $29 million, has been 75% depreciated, is now going to be sold for $8 million with a 35% tax rate. What is the equipment's after-tax salvage value? So I'm going to put in the cost, and that's $29 million. Actually, I should just do this over here because that's a nice big cell to use. So I'm going to put in $29 million. The depreciation on that is 75%. So I'm going to go plus 0.75. and then I'm going to multiply that by 29 million, and I get 21,750. So everybody should see that cost minus depreciation of an asset is the asset's book value. So I'm going to type in BV for book value. So there's my book value. Now the question is, what's my gain? Okay. Well, to compute a gain, you figure out what did I receive versus what did I give up. And I received $8 million. So I'm going to type in plus 8 million. And I gave up book value $7,250,000. So my gain is $750,000. 8 million minus $7,250,000. I have to tax affect that gain. Everything we do in finance is after tax. And the tax rate was 0.35 times the 750. Okay. 262.5. So the net number, the net gain is this, 487.5. Not that I needed to know that. Actually, let me just delete that. We don't really need to know that. So just to minimize confusion, I'm just going to get rid of that. It's not wanting me to get rid of that though, but delete. Okay, I won't get rid of it because my computer won't let me. Something's not quite right there. I'm just hit 0 because we don't need that number. So anyway, the tax effect is 262.5. So the question was, what is the equipment's after-tax salvage value? The after-tax salvage value, I'm going to go ATSV, after-tax salvage value, we'll just do it right here, is the $8 million received, okay, 8 million, plus 8 million, minus the tax. Okay. So I'm going to pay a tax of $262,500 and I'm receiving $8 million, and so the net number that I would include as a cash flow for this is $7,737,500. Okay, so that's my net after-tax salvage value. Okay, there it is. All right, the next one I want to show you is question 6. And question 6 is important because question 6 is very similar to the very similar to the required problem for chapter 12 that you will do. So this is one that you'll be doing in Applia, and so what we do here will be very relevant. So this information I've got here, we're probably going to come back and look at this NPV calculation that I did. So I'm just going to go back up here and just kind of do this over here. And what we have is, I'm going to do this off to the right here. What we have in the situation is we have an individual, Charlene, evaluating a capital budgeting project that will last for 4 years. The project requires $800,000 worth of equipment. She's unsure what depreciation method to use, either straight line or 3-year MACRS. If you don't recall, MACRS stands for Modified Accelerated Cost Recovery System. It is the IRS method used for depreciation. When you use an IRS method, it's accelerated, so you take a lot of depreciation early in the project and not very much later on. And everybody should know what a straight line is. It's just where you take the cost divided by useful years and you just take the same amount of depreciation year over year. So that's the situation here. She's got the two methods. So let's just go make some headings here. So we have 4 years, I should say. 1, 2, 3, 4. And then we have, I'm going to say SL for straight line, and then MACRS. Okay. And for MACRS, I'm just going to type in the percents. I'm just going to enter what they are here. So given to us right here, 0.33, 0.45, 0.15, and 0.07. Let me make it so you can see those. And let me just expand this so I can see all my menu options here. And so right here. Okay, so there are the percents. And so for straight line, the cost was $800,000 divided by 4 years, $200,000. Okay, so essentially now we are depreciating this asset at the rate of $200,000 a year for 4 years. For Mackers, what I'll do is I'll take $800,000, multiply it by the rate for that year, 33%. Okay, I get 264. I can just drag this formula down, and then I've got my depreciation by year. So 264, 360, 120, and 56. So the answer for A, what is the depreciation expense for each year under each method, is right here. Question B says, which depreciation method would produce the higher NPV, and how much higher would it be? So to do that, what I really have to do is I'm going to call this column 1 and column 2. And what I have to do is take column 2 and subtract column 1. Okay, so basically this is my change. So what is the change between the two? So the change is my Mackers minus the straight line. Let me just drag that formula down. It's going to go from positive to negative, which makes sense. Okay, so here's my change. What I have to do next is basically say, what's the tax on the change? So I'm going to type in tax change. Okay, and the tax rate they gave us was 35%. So what I can do is just take 0.35, multiply that by the change. And there I get 22.4, and then go down, drag this down, and I get my answer. So a couple of positives and a couple of negatives. And so the question is, which of these methods would produce a higher NPV, and how much higher would it be? And essentially what I'm doing is an NPV calculation. And the WACC is 8%. And so what I've essentially done is said, how will my depreciation methods change my net cash flows? You know, what will that change be? And you always have to tax affect a change like that. So essentially my cash flows will be more positive in the first 2 years and then more negative. Okay, and so what I have to do is go down here then and enter in my NPV calculation that I've already done. I'm just going to take the one I've already done and go, okay, it's 8%. And then my initial cash outlay is actually 0. It all happens in years 1, 2, 3, and 4. So in year 1, just to use the numbers up here, okay, I'm using the 22.4, the 56, the 28, and the 50,400. I'm going to type those in down here. Okay, so year 1 is the 22.4, then the 56,000, then negative 28, and then negative 50,400. And then basically I got to get rid of those 8,000s because they're going to mess up the formula if I don't. So I get rid of those, and it'll work. You know, this formula is bringing in all 10 periods. If I double click on that, it's bringing all 10 periods. That's okay because I zeroed them out, so it's not going to change anything. You could have just changed the formula to only include years 1, 2, 3, and 4, but I just zeroed out everything that didn't matter, and the formula will still work. So the answer for B then is 9,478. So it's logical to think that the cash flows will be higher in the immediate years because of the depreciation acceleration, because in years 1 and 2 I take almost 78% of the total depreciation and then just a very little bit at the end, whereas essentially the straight line method is, you know, over 4 years, so it's 25% per year. And so it's just going to work out then that an accelerated method will always give you a higher NPV number than a straight line method, which was kind of really what the whole point of this problem was. So, but anyway, this is how you would go about solving the required problem for Chapter 12. Hopefully that made sense. And I just want to show everybody how to actually just build that NPV formula from scratch. It's not that hard to do, and it's worth trying to see if you can do it. It's a good Excel skill to have, to be able to build formulas from scratch. It's always okay just to, you know, take an existing formula and adapt it to your needs too, but it's good to know how to build one too. So that's kind of why I showed you that. But if you have questions, just let me know. Thanks.